Hello and a warm welcome to Econoday Unplugged on Tuesday, the 25th of January 2022. Terry Sheehan is on the US East Coast and I'm Jeremy Hawkins in London. Well, this time last week, a combination of rising inflation, diminishing central bank asset purchases and expected aggressive Fed tightening seemed to have put US 10-year bond yields firmly on course for an early test of the 2% mark. And that may still be the case. But for now, investor sentiment has become more cautious. Worries about the economic effects of a double whammy of higher borrowing costs and ultimately a withdrawal of liquidity through quantitative tightening are being underpinned by the rising threat of war in Ukraine. This has boosted the appetite for safe haven assets and at the same time left equities suddenly looking very exposed. There are central bank announcements from the Fed, Bank of Canada, Bank of England and the ECB, all due over the next couple of weeks. And policymakers are going to have to explain their decisions very carefully or risk a potentially serious backlash in financial markets. So let's kick off with probably the highlight of the week and, of course, Wednesday's FOMC statement. So, Terry, I mean, it looks like we got 4 rate hikes now are pretty well fully priced in. And there's a lot of talk about quantitative tightening later in the year too. So does that look reasonable to you? And particularly in light of the last few days of highly volatile trading, could prospective stock market wobbles have any say in what the FOMC does?
Well, the FOMC tends not to, it's not that they don't pay attention to the stock market, but it's not, because of its volatility at times, it's certainly not the first thing they look at. What they'll be looking at is the economic data, how well growth is being sustained, how well and quickly they're reaching their mandate of maximum employment and price stability. So what they're really going to be focused on this week, I think, is how badly behind the curve they are in terms of inflation.
Okay, you had some, I suppose, slightly negative data over the course of the last week or so. And indeed, you had the composite PMI stuff out today, didn't you? What did that tell us about how the economy is going in January?
Well, the early data for January is looking softer for manufacturing and services here. It's mostly regional data that we've got right now, so it's a little hard to tell. But it really does look like January is going to be significantly slower in activity than December was. Now, that doesn't mean it's stopping, but it's just the robust pace that we've been seeing is definitely turning slower.
Okay, talk about robust pace, and of course we get the first look at fourth quarter US GDP out on, where are we, Thursday, isn't it? And yeah. I guess we're looking for a pretty decent number out of that.
Yes, somewhere probably around 4%, which is much lower than earlier expectations, but still well above the Fed's longer run expectations.
All right, and I guess so, given the focus on inflation at the moment, we'll have the employment cost index, back end of the week, aren't we? Again, for the fourth quarter. We had that, was, if you remember, the record increase last time round. How important do you think this number is going to be for the markets? And and is the Fed going to pay a lot of attention to it?
I definitely think that the employment cost index is going to get more attention than it usually does, partly because last time was a very sharp increase. And this time because they're going to wonder if that increase is continuing and if it's going to start showing up in the form of wage inflation.
All right, and as we pull all that little lot together then, what's Mr. Powell going to say on Wednesday? Do you think it's reasonable to assume now we could get as many as 4 interest rate hikes this year? And when do you think we might actually see a switch to quantitative tightening?
Well, I think that Mr. Powell will be very cautious about signaling any particular path of rate hikes. He's going to go back to the fact that the Fed is data dependent and no decision is made before the meeting, kind of thing. The other problem is that this January meeting is not one at which the policymakers officially update their forecast. So I think he's probably going to duck any questions regarding the number of rate hikes and just refer to the prior December forecasts, although he will indicate that they did some unofficial updating of that. I think the real clue, not so much in the number of rate hikes, will be in just how aggressive the language from the statement and his question and answer period are in regard to the Fed's stance toward monetary policy. Could we see quantitative tightening later this year? I certainly think it's a possibility. I think almost certainly not before late in the year, possibly fourth quarter.
Okay, and in terms of interest rate hikes, I see you're looking at 25 basis points a time. And is March nailed on?
I think March, a 25 basis point increase is very probable. I think there will be some speculation about a 50 basis point increase just to kind of send a strong signal. I don't think that's going to happen. I think the Fed is going to be extremely cautious about lifting rates and doing it in small increments, especially since we see some signs that the economy is going to be somewhat slower in 2022. So they're not going to want to remove stimulus aggressively in terms of interest rates because that tends to slow things down. They can more safely reduce their asset purchases and end them.
Okay, let me ask you in terms, I mean, it's not so long ago that the FOMC were kind of intimating that, you know, the chances of tightening is miles away down the road. And now all of a sudden we got the dimension of financial markets looking for fairly aggressive Fed tightening. What do you think the tone of the FOMC statement's going to be like? Do you think, if anything, yes, it's going to kind of presumably lay the path down for at least some sort of tightening? Do you think it may also stress the fact that, you know, that the Fed is alert to the fact the economy may be slowing down a little bit? It's been reluctant to tighten policy in the past, so although not being dovish, it may not be perhaps quite as hawkish as some folks in the markets are expecting at the moment.
Well, we may see a tweak to the forward guidance language. And in fact, in the last time before they started raising interest rates, they essentially removed the forward guidance language about keeping rates low for a time. So if we see a downgrade or removal of that language, I think we can look to a rate hike sooner rather than later. The other thing is, if the Fed sees the need, there's no reason they can't do an intermediate rate cut, although that would probably require some exogenous event, rate hike. That would require some exogenous event that would give them a particular reason that they needed to act sooner than meeting.
All right, one last question, at least from me for you anyway. Quick look at Ukraine. If we do see the Russians invade Ukraine, so effectively we end up with war in that part of the world, would you think the economic and potential financial implications of that would have any implications for what the Fed might do?
Oh, absolutely. I am not sure exactly what they would do, but I do remember when Greenspan was chairman and we were facing the invasion of Iraq, they basically suspended any bias they had about policy and awaited events. So if that happens, I think we can definitely see language out of the Fed that they will do what they can to support the U.S. economy and make sure any shocks are smoothed over.
Yeah. Right, makes sense. Okay, anything else from your side, Terry?
No, we're really, at this point, mostly looking forward to the first estimate of fourth quarter GDP to have a sense of how severe that downturn in consumer spending is on the data that we saw from December, and to have a sense of whether the prospect of rising interest rates is going to affect investment.
Okay, excellent. Thank you very much as ever. So to Europe and I guess my part of the world then, I suppose really just quickly just mention Ukraine anyway. Obviously at the time we record this podcast, it's kind of anyone's guess as to what's going to happen on the Eastern European borders. But it does at least seem to be the case that the risk of some kind of incursion is steadily rising. Now, for Europe, of course, that would have significant implications. Russia is worth about 44% or so of European Union imports of natural gas. It's by far and away the biggest energy supplier into the European Union, more than double the next biggest exporter, which is Norway. So if we end up with some kind of war or some kind of incursion which results in Russia deciding to turn off some of these flows, it's going to have a huge implications as far as the price of energy in Europe is concerned. We see big increases coming through there. At the same time, of course, we'll almost certainly see a big hit to the economic real economy. So for the likes of the ECB, which, as we talked about so often in the past, in contrast to the Federal Reserve, at this stage has got no interest whatsoever in tightening policy. It gives them a real dilemma. What do they do? Do they respond to higher inflation, which would certainly be potentially, say, a lot higher, or do they try and do something to help to bail out the real economy? In practice, I suspect they go for the real economy side, but nonetheless, it would make it extremely difficult for the ECB to sort out what the appropriate policy stance might be. So we'll have to watch this space on that one. In terms of the economy as it stands at the moment, now, well, we've had some further indications that with the surge of the Omicron cases we had at the back end of last year, and indeed in some parts of Europe, that continues at the moment. For the EU as a whole, it's still easily at record highs, new cases. The January flash PMI, that was down at 52.4, a little bit weaker than expected, but it's an 11-month low. But I guess it's worth pointing out that within that, the price components were again very strong, although there have been some indications that the supply chain issues which have plagued so much of especially the manufacturing sector throughout last year eased a little bit. Output prices were still up extremely heavily. Service sector prices again, although that's the area which got hit most, of course, by the actual increase in Omicron cases anyway. But nonetheless, it looks as if fourth quarter for the Eurozone won't be particularly good in terms of GDP, and the first quarter probably got off to a fairly soft start as well. But really, as far as Europe's concerned, currently most of the focus here, not surprisingly, is on the Ukrainian-Russian border. Stick across to UK, more akin to the Fed. I think the Bank of England is still widely expected to tighten policy again next week. That'll be on Thursday week, so that'll be a second consecutive increase in interest rates. If we do see that, looks probably by a 25 basis point, which would take the benchmark rate up to 0.5%. Now, outright asset sales, so quantitative tightening, won't start the full bank rate, at least under the current guidance, until at least bank rate hits 1%. But the 0.5% is the threshold at which they would stop reinvesting their maturing quantitative easing bonds. And so that would allow the balance sheet, which stands at about just shy of 40% of GDP at the moment, that would allow it to begin shrinking. So the first step towards tightening using the actual balance sheet itself. While they're going to do that, well, last week we talked about a strong employment report out of the UK. We also later on that week had surprisingly high inflation. UK inflation on a headline basis now stands at an annual rate of 5.4%. That's the highest we've had over here since March 1992. The core's up at 4.2%, and that's the highest since June 1992. And even though we did see some slightly friendlier producer price measures, within that, the core indices, particularly on the output side, actually moved up to new record high as well. So however you want to try and cut and dice this data, it still suggests that not only is inflation well above target, but the leading indicator suggests it's probably going to climb higher, at least over the near term anyway. The Bank of England is going to almost have to do something about that. So it does look very much, at least at this stage, and obviously possibly subject to developments in Eastern Europe, as if bank rate will be going up again next week. The other main focus for the UK is domestic politics, I can't really ignore, which I guess in terms of volatility could give an elevated VIX index a run for its money. Earlier on today, we heard that the Metropolitan Police will be investigating the alleged 17 or so Downing Street parties held during the lockdown, and depending upon their and another separate internal inquiries of findings, we could be a matter of days from having a new British Prime Minister. certainly the way things are developing at the moment, it does look very likely that we will see Conservative Party members challenging Johnson for the leadership. And if that were to happen, it seems he would probably have to go. So politics certainly very unstable in the UK currently. Slightly better news, I suppose I should mention in passing with regards to this Ukraine episode. The good news for the UK is about half of the UK's gas supplies are domestic in origin, coming out the North Sea, and another third comes through pipelines from Norway. So to that extent, the UK would not be so exposed to developments in any kind of Russian incursion. Russia only amounts to about 5-6% or so of UK gas supplies. So to that extent, it could turn out that the likes of sterling could outperform the euro by some considerable way, although clearly it would be the safe haven currencies like the dollar, or within Europe, the Swiss franc, which would probably stand to perform best in those kind of conditions. Right, quickly let's look at some of these other central banks. And Bank of Canada will be first of the major central banks. They come out slightly ahead of the Fed tomorrow. And the market's pretty well split on this. I think the consensus would appear to be that there won't be any change in interest rates. But by and large, I think because the inflation numbers have been so high, last week the CPI weighed in at where we are, 4.9% in December. The core rate was up at 2.9%. It's the highest headline rate we've had since 1991. So there's plenty of pressure on the Bank of Canada to come out and tighten. Some of the real economy numbers are starting to struggle now, but that's because of Omicron, and they'll probably want to look through that. So given the state of what's going on with price pressures at the moment, there's at least a very, let's say, significant minority in the market which are looking for the Bank of Canada to actually pull the trigger a good deal earlier than originally expected as of tomorrow. If not, they could well do it with a meeting just after that. But certainly very much the case, it seems that Canadian interest rates, a hike there is just a matter of time. That may also be true now of Australia as one of those central banks which has been seen to be falling behind the curve in terms of monetary policy for quite some while. We had news of their inflation number for the fourth quarter earlier on today, and that again showed another significant increase. Indeed, we had the largest monthly jump in prices, I think, since 2008. The RBA has still sounded quite dovish in recent weeks, but it does seem now that next week's RBA meeting might see an early curtailment of its current quantitative easing program. An interest rate hike at this stage, I guess, is still unlikely, but nonetheless, it could well be now that we'll see interest rate hikes coming through this year and well ahead of what the the Reserve Bank was anticipating, although more in keeping with what financial markets have been contemplating for some time now. She also mentioned that this week we'll get the New Zealand CPI that's due out tomorrow. That's expected to hit a 30-year high. The Reserve Bank of New Zealand's already on a tightening cycle at the moment, and that could well lead to additional speculation that they'll probably hike again at their next meeting. Just to show that there's still a lot of interest rate hikes or tightenings doing the rounds, Singapore, the monetary authority of Singapore came out and tightened its monetary policy in an intermeeting move, which was the first time they'd done that earlier today. First time they've done that since January 2015. And again, surprise, surprise, that simply comes down to the fact that inflation is a lot higher than it should be. The MAS, monetary authority, it manages its policy through exchange rates. It's going to adjust the policy a band. It allows the Singapore to trade in to accommodate a slightly faster rate of appreciation with a view to trying to bear down on import prices. But as we mentioned previously, China continues to do its own thing. So last week we had the People's Bank of China cut its 1-year and 5-year benchmark loan prime rates by 10 basis points and 5 basis points respectively. That followed earlier cuts in the 1-year and the 5-year a few days earlier. And indeed, that was subsequently followed by a 10 basis point reduction in the 14-day reverse repo rate. That now stands at 2.35%. So put all that little lot together, and although officials by and large trying to make out that these moves have been aimed at keeping liquidity conditions stable ahead of the beginning of the Lunar New Year holidays, it really underlines the fact that they are still very much concerned about the weakness of the Chinese economy and the speed with which it is slowing down. Okay, then, I think that's probably it as far as this podcast is concerned. As you probably gather from Terry and myself, there's an awful lot going on in terms of central banks at the moment. There's also a heck of a lot of uncertainty about what's going on in Eastern Europe. So put it all together, and it's likely to be quite a volatile period as far as financial markets are concerned. So be sure to keep up to date with all the key market moving data events in Econoday's global economic calendar. On behalf of Terry and myself, thanks as ever for listening. We'll be back next week and hope you can join us then, as we'll have the full team on board for a more in-depth global roundup. Bye for now. Strategic investing and analysis are a lot easier when you can identify patterns and see how economic events and announcements correlate with specific market movements. The Econoday Investors Journal provides a convenient and easy way to follow important economic events every day, every month throughout the year. View the most important market moving events for the upcoming year in a glance. The Econoday Investors Journal is your essential desktop resource for economic events and indicators, FOMC meetings and announcements, US banking holidays, equity settlement dates, and more. The Econoday Investors Journal is much more than a financial calendar. It's an indispensable tool to help you anticipate active days in the market. Learn the intricacies and interactions of the market, record daily market activity, and explore helpful insights from experienced market analysts. Take advantage of our informative resource centre, which includes a comprehensive glossary of need-to-know terms, clear, concise information on policy and historical trends, useful graphs, and a guide to the influencing factors and people to watch at the Federal Reserve. Order your 2022 Econoday Investors Journal now at shop.econoday.com.